Advanced Risk Management Strategies for Forex Traders. Introduction. Risk management is the cornerstone of successful Forex trading. While basic risk management principles are essential, advanced traders need to elevate their approach to manage risk in a more comprehensive and nuanced manner. In this lesson, we will explore advanced risk management strategies that enable traders to protect their capital, minimize losses, and optimize their overall trading performance. Diversification beyond pairs. While diversifying currency pairs is common, advanced traders diversify across asset classes. Commodities and indices include commodities like gold and oil, as well as major indices to spread risk across various market segments. Cryptocurrencies integrate cryptocurrencies to tap into a unique asset class with potential non-correlated price movements. Correlation analysis. Understand the correlation between different pairs and asset classes to minimize risk. Positive and negative correlations. Identify pairs that move in tandem or opposition and adjust positions accordingly. Hedging. Use negatively correlated pairs to hedge positions, reducing potential losses during adverse market conditions. Volatility-adjusted position sizing. Adopt advanced position sizing techniques that consider market volatility. ATR-based sizing. Calculate the average true range, ATR, and adjust position size based on market volatility. VAR modeling. Utilize value at risk, VAR, models to estimate potential losses in different market scenarios. Pyramiding and scaling in. Gradually enter and exit positions to manage risk and optimize profit potential. Pyramiding. Add to winning positions while managing risk to maximize returns during strong trends. Scaling in. Enter trades incrementally, especially during potential reversals, to avoid large losses. Dynamic stop-loss techniques. Advanced traders use dynamic stop-loss methods that adapt to market conditions. ATR trailing stop. Adjust stop-loss levels based on the ATR to account for market volatility. Moving average trailing stop. Use moving averages to trail stop-loss, providing a buffer during price fluctuations. Correlation-based stop-loss. Set stop-loss levels based on correlated pairs or market indices. Index-based stops. Determine stop levels using major market indices like S&P 500 as a reference. Correlated pairs. Adjust stop-loss levels in one pair based on price movement in another correlated pair. Event risk management. Stay prepared for major economic events and news releases. Avoid trading during high-impact events. Temporarily step back from the market during critical data releases. Use options or hedging. Employ options or hedging strategies to mitigate potential losses during volatile events. Maximum drawdown management. Define and manage maximum drawdown levels to prevent catastrophic losses. Percentage of capital. Limit drawdown to a certain percentage of your trading capital. Review and adjust. Regularly assess trading performance and adjust risk parameters as needed. Stress testing and scenario analysis. Simulate extreme market scenarios to understand potential risks. Monte Carlo simulations. Use statistical modeling to predict potential outcomes in different market conditions. Black swan events. Consider the impact of rare, unpredictable events on your trading strategy. Continuous learning and adaptation. Stay updated on advanced risk management techniques as the trading landscape evolves. Market changes. Adjust your risk management approach based on changing market conditions. Personal growth. Continuously refine your understanding and execution of risk management strategies. Conclusion. Advanced risk management strategies are essential for preserving capital, minimizing losses, and achieving consistent profitability in Forex trading. By diversifying across asset classes, understanding correlations, applying volatility-adjusted position sizing, utilizing dynamic stop-loss techniques, and preparing for event risks, advanced traders can navigate the volatile Forex market with confidence. Continuous learning, Adaptation and disciplined execution of advanced risk management strategies are vital components of a successful trading journey. Remember, while risk management can't eliminate all losses, it provides a solid foundation for sustainable trading success in the dynamic world of Forex.